Picture this. It's 9:07 a.m. on a normal Tuesday. You open your banking app. The number is there. Your number. Clean, confident, comforting. $8,214.32. You swipe down to refresh just because you can. Still there. Now imagine a different Tuesday. Same phone, same app, same number. But today, a small banner sits above it. Due to unusual activity, some withdrawals may be delayed. You feel that tiny drop in your stomach. Not panic, not yet. Just a question that suddenly matters more than your coffee. Wait, if that money is mine, why do I need permission to get it? Here's the uncomfortable truth we don't say out loud. Your bank balance isn't a pile of your dollars sitting somewhere with your name on it. It's mostly a promise that works beautifully until, for a moment, it doesn't. And right now, with interest rates higher than they were a few years ago, with banks sitting on losses they'd rather not talk about, and with instant money moving faster than trust can keep up, this is one of those topics that stops being nerdy and starts being personal. Because if you think your bank is a storage locker, you'll misunderstand everything that happens in a financial scare, and you'll be shocked at exactly the wrong time. So let's do this like we're watching the machine operate from the inside. No jargon, no worshiping the system. Just, what is your bank balance really? Start with a simple scene. You walk into a bank with $1,000 in cash, actual paper. You hand it to the teller. They smile, they stamp, they give you a receipt, and you see it in your app. You feel like you just moved money from your pocket into a safer pocket. But legally and mechanically, something else happened. You didn't put money in the bank like you put a code in a closet. You lent money to the bank. That deposit you made, it becomes the bank's money, and you get an IOU. Your account balance is the size of that IOU. That's not a metaphor. That is the relationship. You are a creditor of your bank. Which is already a little absurd because we don't treat it like a loan. When you deposit money, you're not thinking, I am now extending credit to a financial institution. You're thinking, this is my money and I'm placing it somewhere safe. The system relies on you thinking the second thing while it operates like the first. Now, if you're hearing IOU and thinking that sounds sketchy, slow down. An IOU can be extremely solid. It can be more reliable than cash in your drawer. Cash can burn. It can be stolen. A bank can be insured, regulated, backed by a central bank, connected to payment rails, and, most of the time, boringly dependable. But the key phrase is, most of the time. So what does the bank do with its money after you deposit it? It doesn't put it in a vault and admire it. It uses it. Banks exist to do one core thing: turn short-term money into long-term money. They take deposits that can be withdrawn today, and they use them to make loans that come back over years. Car loans, mortgages, small business credit lines, credit cards, commercial real estate. That's the business model. That's the engine. And yes, they keep some cash and some ultra-safe assets on hand, but not nearly enough to pay everyone at once. That's not a conspiracy. That's just arithmetic. Let's make it concrete with a toy version. Imagine a tiny town bank. It has 1,000 customers. Each customer has $1,000 in their account. The app total across all customers is $1 million. So do they have $1 million in a vault? No. Maybe they keep $50,000 in cash and reserves for daily withdrawals and payments. The rest is out working. Some of it is in loans. Some is in government bonds. Some is in other assets that are considered safe enough to count as liquid in a regulatory sense. That town bank is assuming something very human. Not everyone asks for their money at the same time. And on most days, that's true. Because most of us treat our bank like plumbing. Water comes out when we turn the handle. We don't all run outside and demand the entire reservoir at once. So the system works because withdrawals are staggered. Your balance is real in the sense that the bank owes it to you. But it isn't there in the sense of your specific dollars are sitting untouched. Your dollars got blended into the bank's big pool the moment they arrived. Now here's where it gets quietly weird. If you pay your friend $50 using your bank's app, it feels like money moved, like a little digital $50 flew from your account to theirs. But what often happens is more like accounting. Inside the same bank, it's literally just a spreadsheet move. Your IOU goes down by $50, their IOU goes up by $50. No physical money moved anywhere. And even if it's two different banks, much of what happens is still not money flying, but banks settling net differences through central bank accounts. The bank balance is a number that represents a claim, not a container. So if the system is built on promises and staggering, what's the risk? The risk is not banks are evil or your money is fake. The risk is that the bank is doing a balancing act. It's juggling timing. You want your money available on demand. The bank wants to invest it for profit over time. Those two desires can coexist until something forces everyone to care about timing all at once. That something has a name you've heard before, usually spoken in a hushed tone, like it's a ghost story. A bank run. But to understand why bank runs happen, you need to understand the most underrated force in banking: confidence. A bank can be perfectly fine on paper and still die from panic. Because the problem isn't just whether the bank has enough assets, it's whether it has enough cash right now. Here's the uncomfortable mechanism. A bank's assets are mostly things that pay back over time: loans, bonds, securities. Its liabilities are mostly things that can leave instantly: deposits. That's a mismatch. Again, that mismatch is the business. But it creates a vulnerability. If too many depositors demand cash at once, the bank has to raise cash fast. And raising cash fast often means selling assets fast. And selling assets fast often means selling them at the worst possible time. This is where we escalate from interesting to because the modern bank doesn't just hold loans, it holds bonds. And bonds have a funny property that most people never need to think about until they do. Bond prices fall when interest rates rise. That's not a vibe, that's math. If a bank bought a 10-year government bond when rates were low, say around 1.5%, that bond pays a fixed amount each year. Now, if new bonds are paying 4% or 5%, nobody wants the old low-paying bond unless it's cheaper. So the price of the old bond drops. Meaning, the bank can be holding safe government bonds and still be sitting on big losses if it had to sell them today. And it usually doesn't want to sell them today. It wants to hold them to maturity and get paid back in full. So in calm times, those losses can stay hidden as unrealized. But in a panic, unrealized becomes real very quickly. Because cash is the only thing that counts when everyone wants out. Let's do a simplified version of the math. A bank has $100 billion in deposits. It put a chunk into long-term bonds when rates were low. Now rates rise. The market value of those bonds drops. On paper, the bank might still be okay long-term because if it holds to maturity, it gets face value back. But if depositors start pulling money, the bank needs cash now. So it sells bonds now and locks in the losses now. Those losses reduce the bank's capital. And then the next depositor sees headlines, and they pull money, and then another. This is the loop. Withdrawals force sales. Sales create losses. Losses create fear. Fear creates more withdrawals. And the whole thing is powered by one sentence you've probably said casually. I should get my money out, just in case. That sentence is rational for an individual, but if everyone says it at once, it becomes a stampede. This is one of the cruel ironies of banking. The system is stable because people believe it is stable, and it becomes unstable when people stop believing, even if the underlying assets might have been fine given enough time. Now, you might be thinking, okay, but isn't this what regulation is for? Yes, and also, kind of. Banks are regulated. They have capital requirements, liquidity requirements, stress tests. There's deposit insurance in many countries. In the US, for example, there's the FDIC, which generally insures deposits up to a limit per depositor per bank, with specific rules and categories. Deposit insurance is a huge reason normal people don't worry about bank runs every morning. It turns, I might lose everything, into, I will very likely get my insured amount. It buys confidence. But notice what it doesn't change. It doesn't change the underlying structure. Deposits are still short-term promises funding long-term assets. Insurance reduces the incentive for a run among insured depositors. But it doesn't eliminate runs entirely, especially when depositors have amounts above the insurance cap or when businesses need access to funds immediately for payroll. And here's where your balance isn't in the bank becomes even more modern. Because now withdrawals aren't a line of people outside a branch. It's a few taps. In the old days, a bank run had friction, time, visibility, logistics. Today, the run can happen at the speed of group chats. The moment trust cracks, money can leave in minutes. That's not a hypothetical. We've seen banks face rapid deposit outflows enabled by digital banking and coordinated information flows. So what is your bank balance? It's a claim on a bank. A claim that is extremely usable in normal times. A claim that is designed to be stable and boring. But still a claim, not a box. Now let's talk about the part that makes people uncomfortable, the money itself. When you see your balance, you might imagine it's cash but digital. But in modern economies, most money is not created by printing. It's created by banks making loans. When a bank approves a loan, it doesn't go into a vault, pull out your neighbor's deposits, and hand them to you. It typically credits your account with a deposit. Your balance goes up. New money, in the sense of bank deposits, is created. On the bank's books, it also creates a loan asset. You owe them. So the bank created an IOU from you, and it created an IOU to you, a matched pair. That's the engine of deposit money. This is why your bank balance is not a pre-existing pile. It's a number produced by a system of promises. Again, this isn't automatically bad. It's how modern economies scale. It's how businesses expand. It's how people buy homes without saving for 30 years first. But it also means the stability of money depends on the stability of banks and the rules around them. Your money is, in large part, bank liabilities that function as money because we all accept them as money, because they clear, because they're redeemable, because the state stands behind the system in various ways. Now let's contrast hype versus reality, because there's a story we like to tell ourselves. The hype story goes like this. I work, I get paid, I put money in the bank keeps it safe. End of story. The reality story is more like, you work, you get paid in bank money. Your employer's bank and your bank coordinate to update ledgers. Your bank now owes you. It uses most of what it owes you to do other things. You can usually redeem your claim instantly because the system is designed for staggering and confidence, and because there are backstops. But it's still a promise, not a box. This is why when people say, if everyone withdrew their money, the bank couldn't pay, they're right. And also, that's not a secret flaw. That's the design. A bank that literally held 100% of deposits in cash would be a warehouse, not a bank. It would also pay you basically nothing, charge you storage fees, and make way fewer loans, meaning the whole economy would feel like it's moving through wet cement. So we build a system that trades absolute certainty for speed and growth. Then we added guardrails, capital buffers, liquidity rules, deposit insurance, and central banks that can lend to solvent banks in a panic. That last part matters, because when banks face a sudden need for cash, they can sometimes borrow against good collateral instead of fire selling it. Think of it like a pawn shop window for high-quality assets. Don't dump these bonds at a loss today. Bring them here, borrow cash, survive the week, pay it back. Central banks exist partly to stop the confidence spiral from turning into a self-fulfilling collapse. But even that comes with trade-offs. Backstops prevent cascades, but they can also encourage risk if people assume rescue is automatic. And rescues can look unfair, because they often stabilize institutions that made bad decisions, while regular people are told to be responsible. That tension never goes away. It just gets managed, until it isn't. Now zoom out. Why does any of this matter to you right now in your actual life? Because your bank balance is treated as risk-free in day-to-day life. You use it to pay rent, buy groceries, cover an emergency, run a business, meet payroll. You don't have time to think, what's my bank's asset duration versus its deposit-based sensitivity? You shouldn't have to, which is why the system is built to feel invisible. But invisibility comes with a price. When things go wrong, they go wrong fast, and in places you don't expect. A bank can look fine while interest rates are low and withdrawals are steady. Then rates rise, bond prices fall, depositors find higher yields elsewhere, and suddenly the bank is bleeding deposits and sitting on losses it never had to realize before. Nothing about the loans changed. Nothing about the buildings changed. The difference is timing. The difference is confidence. And timing plus confidence is basically the entire banking system. Here's a quiet, slightly dark joke that bankers and regulators both understand. In banking, solvent and liquid are two different complements. Solvent means you're okay eventually. Liquid means you're okay today. And if depositors demand today, eventually is not helpful. So what should you do with this information? Not pull your money out, not trust no one, not the sky is falling. The useful takeaway is conceptual. Stop thinking of your bank account as a vault. Think of it as a claim, a highly usable claim in a system with protections that usually behaves like cash because the machinery behind it is maintained constantly. That mental shift makes you harder to fool, because you'll recognize the difference between my balance is a number and my money is physically stored. And you'll understand why certain headlines matter, like when depositors flee a bank not because it made bad loans, but because it bought long bonds at the wrong time. Or when a bank announces it raised capital and the market reads it as they needed to, and the story flips overnight. Or when a government guarantees deposits beyond normal limits to stop a panic, which tells you something important. Confidence is the product, and the state is the ultimate underwriter. And this leads to the bigger implication. If most money is bank promises, and banks rely on confidence, then the stability of your everyday money is not just about you budgeting better. It's about the architecture of trust. Who is allowed to create money? Who gets rescued when trust breaks? Who gets inflation when new money expands? Who gets wiped out when a promise stops being believed? And the strangest part is how quiet it all is. You can live your entire life never thinking about this because the system is designed to let you ignore it, until the day it demands your attention. One final scene. It's a Friday afternoon. A rumor starts. A bank is having issues. Nobody knows exactly what that means, but everyone knows what to do with their thumbs. Transfer, withdraw, move to a bigger bank, buy a money market fund, do something. By Monday, the bank is either fine or it's gone. And your balance? That comforting number? It was never a stack of bills. It was a sentence the bank wrote to you. I owe you. Most days, that sentence is as good as gold. But if it's as good as something, it isn't the thing. So here's the question that sits under everything we just talked about, and it's not settled. It's not even close. In a world where money can leave at the speed of a rumor, how long can a system built on staggered withdrawals keep pretending we all still move at the speed of a line outside a bank?